Welcome, everyone, to Noble Capital Markets Basic Industries Virtual Equity Conference, and thank you for joining us today. I'm Mark Reichman, Noble Senior Research Analyst covering the basic materials and industrial sectors. I am pleased to introduce Mr. David Nark, Senior Vice President and Chief Marketing Communications and Investor Relations Officer for AZZ Inc. AZZ, headquartered in Fort Worth, Texas, is North America's leading independent provider of hot dip galvanizing and coil coating solutions to a broad range of end markets. The company's shares are listed on the New York Stock Exchange under the ticker symbol AZZ. David?
Thanks, Mark. Always a pleasure seeing you, and thank everyone for your interest in the company. I'm going to go ahead and walk us through our investor relations presentation. That should take me about 10 or 12 minutes, and then we'll leave some questions at the end to go through. So real quick, if you're not familiar with the company, this slide that says why invest in AZZ shows you a picture of our corporate office and really just a summary of the company. We are a metal coatings provider based here in Fort Worth, Texas, as Mark mentioned. We only serve the North American market through two segments that I'll go into detail on a little bit later. A metal coating segment that provides hot dip galvanizing, and a coil coating business called Precoat Metals that provides coil coating solutions to the North American market. As you work through the presentation with me today, you'll see that we have been growing both sales and margins. We've got some fantastic multi-year secular drivers in place, generating a lot of free cash flow, and do that while providing some environmentally friendly solutions, with ESG being a focus as well, to the market. When you look at our capital allocation strategy, and we'll talk a little bit about that, we do have a very focused capital allocation strategy that's based first and foremost on reducing debt. I'll explain the reasons why as we go through that and talk through the strategic transformation that we completed a couple of years ago. Improving our leverage ratio, focusing on some high ROIC investments, and returning capital to shareholders. We do have a strong commitment to EPS growth, and I think as you'll see as we go through it, it's a pretty good investment opportunity for you to consider. So real quick, high level, just some numbers. Not going to spend a whole lot of time here. We have sales through our fiscal year 2024, which ended in February of this year, of $1.5 billion. We have an adjusted EBITDA of $334 million, including corporate costs, at a rate of 21.7 adjusted EBITDA margin. The company has 48 locations on the metal coating side of the business, which we'll get into a little bit later, and 13 coil coating locations. And if you look on the left side of your screen, you can see the light blue and the dark blue dots that show you visually kind of where we're located throughout North America. Won't spend a whole lot of time on this slide. Just a couple of points I want to point out to you, starting in the middle, that FY19 through FY 2024. That was really a period of time that, as I mentioned, we worked on our strategic transformation. In doing so, we divested a lot of resources. We added in Precoat Metals just 2 years ago, and have been diligently reducing our debt. When we took on the Precoat Metals acquisition for over $1.2 billion, it moved our leverage ratio up to 4.2 times. As we talk today, we're now down to 2.8 times. So we've been working very hard at that and very proud of the results thus far. Moving us just to the right of that, and you can see, FY 2025 and beyond, we're really focused now as a metal coatings company. We'll talk a little bit about our aluminum coil line that we're adding in Washington, Missouri, and talk about some of the other things, the long-term drivers, the investments in technology, et cetera, that we're making. This slide, real quick, you can read through it. Just a few things that I want to point out. Again, we're very committed to stating some commitments when we took on the Precoat Metals acquisition and transformed the company. And as I had mentioned, worked very diligently down the list here. And you can see we've checked all the boxes on all the things that we said we would go do and have delivered those to our investors, which I think has really just strengthened our credibility within the investment community, that we're very sound investment choice and backed by a very strong management team. And speaking of the team, here they are. Tom Ferguson, our CEO, has been with the company for over 11 years, as have I. And then we've got Jason Crawford, our Chief Financial Officer, who came to us through the Precoat Metals acquisition. He's been with the company here at AZZ for 2 years, but with Precoat for more than 8. We have 2 very strong and seasoned leaders of each of the segments. And then Tara is our CLO, and Chris runs BD for the team. But we've all been together for a number of years. And like I said, very solid team. Wanted to just touch real quickly on end markets. On the bottom left pie chart, you can see our sales by end market. Construction is our largest end market, representing about 55% of our total sales in fiscal year 2024. Followed by industrial, transportation, consumer, electrical, and then an other category. I just compare and contrast that to the pie chart that's just above it, which comes from World Steel, and just shows you what the typical end markets for steel in North America is. So we represent the market pretty closely, and we'll talk a little bit about all of those in more detail. Couple of things just on some secular tailwinds that really enhance the outlook and are making us more optimistic as we move forward. One of them is the investment that I think we've all seen in infrastructure as well as renewables in North America. Certainly as a leading provider of galvanized steel and coil coating steel, that's certainly something that we're right in the middle of and are benefiting from. Likewise, the reshoring of manufacturing coming back from overseas is also something that is benefiting us, because that just means more buildings are being built, particularly on the construction side and in the manufacturing or non-residential sector. And so we're benefiting from that as well. Just as we are some of the other things you see listed here, the pre-painted steel and aluminum migration, and the conversion that's happening in the consumer sector, where consumers are now starting to make more of a choice and choose aluminum products on the shelves. For instance, canned water that's in an aluminum container versus plastics, because they're concerned about microplastics and things that might be leaching into their water. So again, something that is benefiting the business. I won't spend a whole lot of time on this slide. This just again shows you across the spectrum some of the areas that we're benefiting from as a result of the AIIJA Act and the investment that's taking place associated with roads and bridges, clean energy and power, and then water, airports, and other. Want to quickly just, if you're, again, not familiar with the company and this is your first introduction to it, give you a quick rundown on the 2 segments in the business. So we have 2 segments that we go to market in. One is a metal coatings business. You can see the sales for the last 12 months there. And then our Precoat Metals business. To kind of compare and contrast those really quick, the metal coatings business, what it's doing is it's galvanizing fabricated steel. So the steel is leaving a mill or a service center, it's being shipped out to that steel fabricator. They're forming it into its end use. It might be a bridge beam, it could be a lattice tower for transmission distribution, could be poles and light fixtures for along highways and byways. It could be boat trailers, just a number of different things that you see that as you drive down the road, you probably don't notice them that much. It's that gray steel that's kind of all around you. That's what we do. We make it gray, which is the galvanizing, and it makes it last for 50 to 100 years without rusting. That market size is about $2.2 billion in the US. We have a 27% share, number 1 market position. We're 2x the nearest competitor. And likewise, when you look at Precoat Metals, a little bit different process. What we're doing there, we're taking that coiled steel, is a very large, big, heavy coils that can weigh up to 46,000 pounds. That's being sent to us from the manufacturer, and we're unrolling it, running it through an automated process, painting, rolling paint across the top of it, drying it and rolling it back up, and then sending it to the manufacturer, who then fabricates that into its end use. Again, Market size there is twice the size as our metal coatings business. Again, a #1 market share position and a 20% share. Couple of things just real quickly on why these businesses make sense together. Both, as I kind of mentioned or alluded to, is that they're standout leaders and best-in-class financials and strong market position in their categories. Both are tolling businesses, and I think this is an important thing to know. AZZ, we do not purchase steel. We do not have commodity risk associated with steel or aluminum. That is something that our customers are procuring, again, from a mill or a service center and then shipping to us. And we only have it briefly in our hands while we're providing our value-added solutions to it, whether it's galvanizing or coil coating. So we are absolutely insulated from any price volatility associated with steel because we're not purchasing it. Both have a lot of technology that we've employed into the business and a very service-driven culture. We monitor customer satisfaction through our CSG scores and use Net Promoter Score for that. And also very focused again on some ESG initiatives. Given the time, I'll skip through the value props of these things as well as the historical financials. I think we kind of covered the financials pretty good up front in the presentation, so no need to really dive into those within each segment. I do want to spend a little bit of time just also talking about how we're investing in growth. We do have a $125 million investment that we've been making in a new greenfield facility being built outside Washington, Missouri. It will be online and active by the end of this fiscal year. I've just been there 3 weeks ago. It's coming along terrific. It's on track and under budget. So we feel really good about where it's at. The other thing that's really important about this is it's the reason we chose to invest in this was not only the secular drivers that we see in the aluminum space, and this will be a facility that's dedicated to coating aluminum for the container industry, but it's also backed by a $50 million per year contract with a customer over the period of 7 years. So certainly a great investment. And that 50 million, by the way, is only for 75% of the capacity of the facility. Technology, again, I won't spend a lot of time here in the interest of time, so I want to get to questions. But as I mentioned, we have invested in technology, both in our digital galvanizing system for our metal coatings business, as well as the Precoat platform, which is called Coil Zone, which really creates a big advantage and a strategic advantage to us versus our nearest competitors in the marketplace. Real quickly on sustainability. We are, I think the main points here on this slide, we are essential and environmentally friendly, as I kind of mentioned up front. We do have a lot of sustainability initiatives and reporting already in place, and certainly we also focus on diversity. And when you look at AZZ, 52% of the workforce is considered diverse. Here's a real quick 5-year look at historical sales and EBITDA. So again, you can see a nice growth there over the period in both, and very robust margin profile as well in the business. Kind of rounding things out, just a couple more slides and we'll get to questions. One of the things that we often get asked is, how do I comp you and look at you vis-a-vis, others in the industry? And, we are a little unique. So one of the things that we've done is kind of taking out some of the guesswork for you. If you look at AZZ on the far left and you compare us either to coatings, building products, service centers, or steel mills, take your pick which one, and you look at revenue growth, adjusted EBITDA margin, or net working capital, as you can see, we're pretty much a standout amongst any way you want to comp us. So again, I think it just lends credence to our strength and where we're going. I did mention the leverage ratio coming down. As we speak today, we're actually sitting at 2.8 times. This slide refers to the preferred. The preferred's actually been taken out, so our balance sheets become not only simpler and cleaner but stronger, and so we feel really good about where we're at. And again, capital allocation priorities very quickly. You can see we're focused on deploying capital on high ROIC investments. We've got them listed there, reducing the leverage and returning the capital through dividends. We are a consistent dividend payer and have been a consistent dividend payer for decades. Real quickly, I'll end up on some guidance for the year, and then we can jump to questions. Our guidance for this year is sales of 1.525 to 1.625 billion, adjusted EBITDA of 310 to 360 million, and an EPS range of $4.50 to $5. So with that, I'll pause and we can open it up for questions and throw it back to Mark. Mark?
Thank you, David. I wanted to begin by discussing the market structure of each of AZZ's business, i.e. whether they're fragmented, concentrated, and what differentiates the company from its competitors, and what are AZZ's chief competitive advantages in your view?
Yeah, great question. So, as I was talking about those two segments that we have, the metal coatings and the Precoat Metals segment, I think, as you look at both of those businesses, they're both still those segments. They're both still operating in relatively fragmented, industries. The metal coatings industry, there's about 140 to 160 different locations out there, including captive kettles and individual tolling providers like us. As I mentioned, we have about 41 of those locations today, so still very fragmented industry. And then likewise on the Precoat side, I think there's about 160 coil coating lines in North America as well. We're operating 13 of them today. So again, very fragmented industry. And as you look at either one of them, kind of talking about our strategic advantages and why people would choose us, I think number one is going to be our footprint. I mentioned that we're the largest in North America. So 41 galvanizing locations, like I said, we're twice the size of our nearest competitor. So having 41 locations puts us very close to the manufacturing base. And we can quote turnaround times that are typically in a 3 to 5 day timeline, which provides a big advantage for customers, particularly if they're working on steel that's part of maybe on the critical path of a large project that needs to be completed. We've got the technology that we've invested in as well, digital galvanizing system. It's kind of the Domino's pizza tracker, for lack of a better word, of the industry. So we've invented that. We've got that in place. It allows us to communicate with customers real time, give them real-time status updates, as does our coil zone solution on the Precoat side. Precoat, very similar, same scenario there. They have 13 coil coating locations strategically located either near mills or service centers or along ports and waterways. So that just allows us to better, serve the customer base as well. And again, the kind of ditto on the technology.
In your presentation, you mentioned some of the tailwinds that support an attractive organic growth profile. But in terms of potential acquisitions, what are the company's investment criteria?
Yeah, great question. So two things to kind of note there. We have been we had taken a pause on M&A for a good 2 years after acquiring the Precoat business, and had made that commitment to the market that before we would even entertain any further M&A and growth in inorganic, we would first delever and get in the range of kind of 2.5 to 3 times debt to EBITDA, and we felt that would be a more comfortable place to operate. We're now there. We're in the 2.8 times, as I mentioned. And so we've kind of signaled to the market we're back in the game. We're looking for strategic opportunities that fit within the two segments that we operate. So what can we bolt on in the metal coating segment, or what can we bolt on in the Precoat that just further strengthens those businesses? So that's kind of what we're looking at on a high level. Investment criteria for us, we're looking at adjacent markets and kind of filling in white space. And then, from a financial standpoint, obviously they've got to be accretive, and we're looking at returns in excess of our weighted average cost of capital. And then we also look at things through an ROIC lens as well, and have certain metrics around an ROIC target that also cascades through the executive team and our compensation package.
Within the Precoat Metals segment, AZZ targets adjusted EBITDA margins in the range of 17 to 22%. What impact do you think the new facility in Washington, Missouri will have on the margins for that segment?
Yeah, thanks for that. So as you said, Precoat Metals, the stated range 17 to 22%. We've been running right in the middle of that, kind of high 19, low 20%. So we feel that we're, kind of right in the middle of the range. The nice thing about that new plant that we talked about is that the contract associated with that I mentioned will allow us to have an EBITDA when it's running at full capacity and full production on the high end of that range. So it will be nicely accretive to the margins.
Well, and then also in fiscal 2025, capital expenditures are expected to be in the range of $100 and $120 million. A portion of that is due to this new facility. Absent acquisitions, what do you think is a normalized capital spending range?
Yeah, a normalized capex for the business on a whole is going to be about $60 million, probably $30 million spent equally between each of the two segments. And I think that's just, again, part of what makes this story so exciting is that generating a significant amount of free cash flow already that's allowed us to pay for the facility in cash, allowed us to continue to delever the business. And now, once we get past that, we're going to have, the inflows of cash coming from the new facility, and then, also the lower capex associated with that. So, it's really just setting us up to have a really nice storyline going forward.
You expect to execute any additional contracts for the remaining capacity?
Yeah, we do. We've got a couple of options ahead of us. The current customer that we have under contract, who we unfortunately can't name yet because they haven't allowed us to share that, would be more than happy of taking actually 100% of the capacity. We've only held back on that because what we felt is that, again, as I mentioned, it's a 7-year contract. We didn't want to necessarily be in a position 7 years from now where, the entire facility is being, consumed by one customer. So we think, having a couple other customers in there will be great. And we do have line of sight to that. So no concern at all filling the balance of the capacity one way or the other.
Well, you touched on ESG, and so I don't want to leave that topic unchecked, but could you just briefly touch on the company's ESG oversight structure, I guess, starting at the board level and the company's efforts to promote sustainability and high ESG standards?
Sure. Yeah, a couple of things there. So we've been really making a lot of strides on ESG. We do have Tara Mackey, who I mentioned, on the slide with she's our chief legal officer, also heads up all of our sustainability efforts and ESG efforts. And you kind of call her the chief sustainability officer in addition to chief legal officer. The board regularly gets updates on ESG and ESG initiatives. So, Tara does a quarterly update with them on that. A few things, I kind of glanced over that on that slide, but as we went kind of a level deeper, if we had the time, we've been reporting on things like Scope 1 and Scope 2 emissions now for over 3 years. We've been very diligent about putting a ESG report out, very comprehensive. I encourage folks who are interested in ESG and that's part of their investment criteria. Please visit our website. Go up to the top. You'll see a link to sustainability, and you can pull down those ESG reports and see everything that we're doing there. But a lot of great work being done, and I think it's being recognized too. Newsweek magazine has twice, 2 years in a row now, ranked us as one of most, America's most sustainable companies. So we're really proud of that. A lot of effort goes into it, and we think it's just also kind of the right thing to do, and you operate in an environmentally sound manner, and then also the diversity lens, as I mentioned, very diverse business.
Now, you mentioned the expanding use of customer-centric technologies, and and I was wondering what impact you expect new technologies, whether that be artificial intelligence or others, to have on your business over the next several years.
Yeah, it's interesting. So a few things there. Number one, we'll continue to invest in technology. We take a very pragmatic approach to it, and where it can help us either on improving customer relations or helping us out in the operations. We're always keen on those things. We have a partnership in place today with Texas A&M University, just in terms of technology and different types of initiatives there. So that helps us out because we get first mover advantage of any research findings that they come up with, and then they can deploy them into the business. The other thing too is I was just at a conference with our CEO, and we were the conference was equally split between CEOs of businesses that were there and the academic universe, and a lot of folks from Stanford, from Yale, from Duke. And so we listened to some interesting presentations from them, as well as also some AI companies on artificial intelligence, good and bad, and also things like quantum computing and others. So I think there's some applicability there. We're looking at a few things, nothing really to announce yet, but we do believe that AI will play a role in the business as we move forward.
And then just lastly, the company typically reports their second quarter earnings in October. Are there any other things investors should keep an eye on during the remainder of the year?
Yeah, it will be out in early October, as you said, with Q2 results. And as we kind of progress through the year, I think look for us, not only as participating in your conference now, but we look to see everybody again, back in December at NobleCon down in Miami. So that's going to be another touch point. Looking forward to that. I'll be there. So if anybody wants to talk real time and dive deeper on AZZ, be happy to do that.
David, thank you for your presentation and AZZ's participation in Noble's Basic Materials Conference.
My pleasure. Always good seeing you, Mark. Take care, and thanks everyone for your interest.